Welcome to the annual meeting of shareholders of Peyto Exploration and Development Corp. I'm Jean-Paul Lachance, and I am the President and Chief Executive Officer of Peyto. Okay, so today we'll start with a reminder of who we are, especially for any new folks to the company. We'll talk about the importance and excitement around natural gas and why we think we're in the right business. We'll talk about what we do and how we do it. We'll talk about our recent successes and a little acquisition update. And then we'll talk about what's next, 2024, and as we move forward beyond that. And after all that, I hope I can answer any questions. Hopefully I have the answers to your questions. First, a reminder from our legal counsel, although they didn't write this. Theirs is at the end, and it's about 3 pages long with really small print. Just a reminder, today we're going to talk about Peyto, Peyto's past, Peyto's future, and of course we'll be truthful in those statements, but the future obviously is built on some assumptions, so we call those forward-looking statements. As you all know, oil and gas and exploration and production is a risky business, so of course you're going to do your homework. And I will blame myself if things don't work out, so I don't need you blaming me too. Okay, so as everybody knows, Peyto celebrated 25 years last October. We continue to make the Deep Basin our home, and we're very good at it. We're very successful at it. We're the 5th largest Canadian gas producer. We've always had an own and control strategy. We own and operate our plants, and so we can control the production and the development in our areas, and that our focus is on plant utilization and keeping that up, which leads to lower costs, and of course we have the lowest costs in the E&P, Canadian E&P industry. We're also always focused on per share growth and returning profits back to shareholders. Currently we pay a handsome dividend that's well protected by our hedging policy and our low cost structure. And we do all this with 84 odd staff in the office and plus consultants. Well, they're not odd, some of them are, but not all. We also we hired some great people from Repsol who know the assets really well and fit into with the Peyto culture, so we're happy with those folks that have joined us. They're not the odd ones. We also have a very dedicated mix of employees and contractors in the field who keep things running 24/7. And I mentioned this earlier, we always measure success by looking at our per share metrics and trying to improve on those every year. So if we look back at a few of these metrics last year, production was up 1% year over year in total, but down 9% per share, and that was due to the issuance of 17 million shares for the Repsol acquisition. But of course, we only got a fraction of the production for the year. It came on in late October. So we look forward to 2024, and we put that, there's a green bar on there that kind of demonstrates where we expect 2024 to be. You can see that we're now back up and growing in the right direction with a full year of Repsol production in there now. 2P reserves were up significantly with the acquisition at 40% year over year, up 26% year per share. And now we have almost 8 TCFE of gas and liquids. Funds from operations was down in 2023 due to lower commodity prices, but the value of our 2P net asset value was up 7% on a debt adjusted per share basis. So 23 all in all was another good year of growing our assets on a per share basis, and 2024 should be even better. So this is where we operate, folks. This is downtown Peyto. This is where we call home. We have about 1.1 million net acres in this area in the Deep Basin. We own and control 17 gas plants. We have with about 1.5 BCF a day of processing capacity, gross processing capacity, and we're over 90% working interest of those, and currently only have them about 50% utilized. It's a great location for egress. We don't have the same challenges as the Montney players up to the northwest, so it's in a really good position in the basin. We have a very experienced drilling and completions team who've drilled a lot of wells. Drilled 1,300 wells, so far, horizontal wells to this point, across 13 discrete formations, and that totals over, if you put them end to end, that totals over 5,500 kilometers. Which basically on a measured depth basis, and that would basically drill across Canada if you were to put them end to end. So We also have an awesome production operations crew in the field that keeps us all humming with some of the best online time in the business at 98%. We always think of total shareholder returns, and we think that's important, and our past certainly demonstrates how much we've paid to shareholders, and we plan to continue. If you got in early, and some of the people here have done that, you've accumulated the equivalent of $21.64 per share, and you now have an interest in a company that trades at an enterprise value of $4.3 billion with 2P reserves close to 8 TCFE, as I mentioned earlier. And we expect it to go up from here. Gas is now a global commodity with LNG container ships, floating across all of our oceans. There's another 12 BCF a day of egress capacity coming online in the next several years to quench the world's thirst. Potential demand growth in the U.S. alone is substantial. Of course, more coal retirements and now AI-driven data centers. It's been a big part of the demand growth already in the U.S. EIA, IEA, and other data sources predict ranges to about 5 to 16 BCF per day for more coal retirements in the U.S. and another 5 to 10 BCF a day demand for data centers by 2030. So that means another 10 to 25% increase in supply that needs to be built between now and then. So I think we're in the right business. So how do we help? How does Peyto do it? How can we supply the world with its energy needs and natural gas? I mentioned earlier at the very beginning, we've always been in a deep basin player, and that I always think of that as a real advantage, because I think the deep basin is one of these sort of forgotten plays with all the Montney development that's going on and all the excitement around that. But the deep basin is a world-class play, right? If you think about it, it's 500 to 1,500 TCF of gas in place, and we still have much of that left to recover. The other thing I like about it, of course, is that it's for the most part a tight sandstone, which means it's got better reservoir quality, better permeability than, say, the Montney siltstones or the Duvernay shales or the U.S. shales. So what does that mean? What that translates into means we use a lot less sand and we use a lot less water to liberate those molecules, to get those molecules to flow to surface, right? And that means, a smaller footprint, obviously cheaper costs. We don't have to pump as much down the hole, and so obviously environmentally friendly as well, relatively speaking. So the other advantage this area has, you look at the map on the bottom right there, we have lower tolls. That we only spend about 19 cents to get our gas on it where we are, and it's considerably higher to the north. If you follow up the Montney Trend, about 55 cents to get it on stream, but also in an area where hydraulically it's better, so lower pressures, more space in the system, as it were, to get in there. So we have a real advantage. We carry about 20% more firm transportation to get into the system already, but we can get more if we need it. So we have the ability to grow into that, and it's also protection, or I would say insurance against times when maybe the NGTL needs to cut back for summer maintenance or whatever. So I think we're located in a really good spot for that. The other advantage we have is we have available plant capacity. I mentioned at the beginning we only have 50% of our gas plants full. So we have a real advantage as development's gone north up to the Montney plays. Repsol is a good example. Their facilities were only 35% full, and so there's plenty of opportunity to fill plants without having to spend extra money to build new facilities in this congested area to the north. So that means our costs are lower. We don't have to pay for the full cycle costs associated with building new gas plants. So that also helps. And the other advantage I like to point out is that we don't drill super long horizontals. We don't need to, because our permeability is really good. So we use a smaller rig. We use a tele double rig, a more fit for purpose rig, a rig that we can basically rig release and spud it on a new location in the same day. Transport's easier around. It means we can start paying out our capital even quicker because we can get wells on stream faster. So a real advantage. And this is not a rig that's typically used in the Montney play, so there's not as much competition for it, so it keeps rates down. And of course, above all that too is also the fact that it's mostly sweet gas that we chase, and so it's easier and it's cheaper and it's safer to operate. So that's the Deep Basin, and why we like it and why we're so excited to continue it. But this is a I want to point out this is really important about cash costs. I mentioned earlier that our cash costs lead the Canadian E&P industry. And you look at the left-hand side there, and you can see that's 2023's cash costs and where Peyto fits amongst our peers. And that's important, but it's really important because costs can be sticky, right? And so, but what really matters is the plot on the right, and that's the margins. So that's last year's margins. And if you look at that, if you move to the right-hand side of that plot, so Peyto being relatively dry, as you move to the right-hand side of that plot, you can see even the liquids, you know, the players with a lot of liquids, we outperform them on a margin basis. And I think that's the important part to take away from this slide. So I'm just going to let it sink in for a second. Of course, we have to, we also want to keep an eye on how much we're spending to add new reserves. And so we have always been focused on profitable growth in this regard. So Peyto leads the industry, or did lead the industry last year in PDP F&D costs, again. And we continued to grow per share as well, as I mentioned at the beginning. We also have long reserve life. Our reserves are 10 years reserve life for reserve life index for our PDP and 30 years for our 2P reserves. But I think the most important part of this slide as well is the bottom right plot that shows our recycle ratio. You know, how much did we make relative to what it costs us, right? So how much profit did we make on that? And we're nearly 3 times the ratio last year, which I believe was also top of the class, as it were, or at least close. And of course, our team is always striving for continuous improvement, and so I expect we'll see some pretty good numbers again this year. So of course, let's talk a bit about some of the successes we've had over the last year. The big event, of course, last year was the Repsol acquisition. It's been going great so far, and it looks great going forward. On the left-hand side there's a plot of the performance of the average performance of 15 wells now that we've brought on stream. And so far they're exhibiting a 30% sustained increase in productivity over our legacy programs. And I think the other important point on this slide is to really to show this isn't from one species and in one area. If you look at the little the red dots, if you can see them clearly, maybe not as well on the screen, but that's where we were drilling, and it's actually not just one area, as you can see on that plot, but it's also different strata. So that's everything from the from the Notikewin to the Upper Flare, Wilrich, and there's even a Blue Sky well in there. So it's not just one particular species in one particular area that's driving this performance. And we recognize 800 locations internally on these assets, and so we've got 15 on stream and 785 to go. So the future looks bright there. But of course, as we drill these wells, we will expect to find even more locations to be uncovered with time. So anyway, this is the reason we bought these assets, but it's not the only one. We also see incredible synergies with the facilities in the field. Todd's group, Todd Burdick, our VP of Production, has been busy. His group is very busy on optimizing our plants and our gathering systems in the field. Some of these projects, like connecting plants and debottlenecking routes for our new drilling program, rerouting gas for lower costs or better recoveries. And a really good example of this was the ethane rejection project that we talked about here recently, where we took gas that was going to a third-party deep cut facility and recovering ethane and put that back in the gas phase and just sent that gas down to the Edson gas plant. And what we're doing there is there's really no difference in value in ethane, whether it's in the gas phase or the liquid phase. So there was no really incremental value in that, but it was costing us money to go to the third party. And so we've redirected that gas down to Edson, away from a third party, not paying them fees anymore to do that. And it's also helping our operating costs at Edson by diluting the fixed costs there. So a real win on the operating cost side of the business. And that's the kind of stuff that Peyto is going to continue to look at. This is a list of projects that we've got on this screen here for, there are various stages of approval, but we've got enough confidence in our plans this year that we've set a target to drive down our operating costs by 10% from Q1 levels by the end of the year. Another exciting play we've got working on is the Dunvegan, and we started on this on our own lands before Repsol, and we got a bunch more locations when we did the deal. It's not quite as rich as the Cardium play. It's about 20 to 30 barrels per million here. of liquids in the gas, comes with the gas, but it's got better deliverability overall, and it's driving better economics right now. So we have a rig dedicated to that play for the rest of the year. We expect to drill 10 to 12 wells in total for 2024, and we actually have we have 100 locations on the books right now, so we have plenty more locations to drill as follow-ups in the years to come. This next slide is a plot of last year's well results. Altogether, the program yields an estimated full cycle return of around 34%, which is pretty good. And we show all results here, right? The good, the bad, and the ugly. We don't hide our results. We show everything, and including those results that didn't make their money back. In this case, our Notikewin program was was a really good program last year, yielding a great rate of return, and so was our Wilrich. And I should point out that there's only 8 Repsol wells included in this mix. And so we know the program has been delivering much better results, and so I imagine that 2024 set will be much stronger. And of course, shareholders don't get involved in the drilling of wells, but they do get to share in the overall profits of the company. And it's out of these profits or earnings that we pay our shareholders. Over the last 25 years, we've invested $8.5 billion of your capital. We've generated close to $3.5 billion of earnings, and we paid out $2.9 billion in distributions and dividends. That's staggering when you think about it. Over time, we aim to match our dividends to our profits or earnings, although the next couple of years we are going to focus on paying down some debt to delever the company. But rest assured, both dividends and debt repayments will continue. So let's talk a bit about our plans for 2024. We're targeting the low end of our guidance, $450 million. That should drill us 70 net wells. Of that $450 million, 80% of that will be related to the wells. So, based on our latest cost structure. We also have some facility costs to spend in here. The balance of that $450 million will be in some facility projects. We have the turnaround at the Edson gas plant. We have some compressor modifications near Old Man, which actually have been completed now to accommodate some pressure increases on the NGTL system. And we're also going to spend around $10 million towards abandonment and reclamation projects to get our liabilities down a little bit here over the years. So that is the plan for this year. We're, of course, going to be flexible in our program, as we always are, and we'll vary that depending on where prices go from here. And as mentioned earlier, margins drive profits. And I really like looking at the business this way, where we include our total supply costs and look at our full cycle netback. We've been able to deliver or maintain greater than 30% margin over the last 25 years, and most recently over 40%. Our goals for 2024 should allow us to maintain that same 40% margin. If we look at the details here, we are expecting that we can deliver a finding and development cost, a PDP FD&A of around $1.10. That's our target. That's recognizing an improvement in the quality of the wells that we're drilling this year on the Repsol assets. So I believe that's a very reasonable target, if not a little bit high. Our cash costs, roughly the same as 2023. Royalties are down, but interest is up because of the acquisition. And op costs are also up due to the higher cost Repsol assets, but we're working those down as we discussed earlier. We have a target, again, of 10% reduction, decrease to those costs by the end of this year. And when it's put all that together, our total supply cost works out to be about $2.55 an MCFE. And when you look at a full cycle netback and you look at our sales price, which combines, of course, not only current strip, but also, more importantly, the fact that we have 70% of our volumes are actually hedged, our gas volumes are hedged, and so that's driving a lot of our revenue. So much of our revenue is fixed, so that gives us confidence in this full cycle netback, which is going to should yield us a margin of around 42%. So, good year expected for 2024 all in all. This is a guide to what we're planning on drilling for the rest of the year. It's essentially our type curves, as it were. The plays that are highlighted in a box in red there, the Dunvegan, the Notikewin, and the Wilrich are the plays that we're pursuing for the rest of the year. And of course, we have a very healthy inventory of 1,600 wells on the reserve books, which
at 70 to 80 wells, it's, that's 20 years of drilling in front of us alone, never mind including our 1,800 locations that we recognize off the books. But you can see by this plot that, even at $2 gas price, there's some pretty good rate of returns here. Now, of course, we hope that's going to improve, but, that's the reality of the quality of the kind of plays that we're pursuing for the rest of the year. So this next plot is a graph of our production history and our contemplated 3-year plan. It's, of course, subject to change, pending prices, but we should be able to achieve this essentially with the improved capital efficiency and balanced program on both our old legacy assets and our new assets. We need to offset a 25% annual decline. This year, we should be able to exit the year at around 135,000 BOEs a day, all things under the $450 million capital plan under that low end of the guidance. And that's despite the loss of 2,000 barrels a day of off the base of low-value ethane that we talked about earlier, how we put that back in the gas phase. And the net effect of that was to lose 2,000 barrels a day, but we still think we can achieve our 135,000 BOEs a day exit because of the quality of the drilling program we have in front of us. So over the next 3 years, including this year and the next 2 years, we expect to spend between $450 to $500 million, and that should have us growing up outwards of 155 to 160,000 BOEs a day by the end of 2026.
And what does that all translate to? This plan grows funds from operations and reduces debt under the current strip and with our strong hedge book and continuing low-cost operations. This gets us to under 1 times debt to EBITDA by the end of 25 or somewhere in early 26, or maybe even sooner if prices run. So let's talk a bit about our hedging, and because it's obviously an important topic these days. Just a reminder why we do it. We do it to get predictable revenues to support our drilling program and our shareholder returns and manage the balance sheet and smooth out volatility. So our mechanistic approach over the years has been profitable with a cumulative of $290 million of financial hedging gains. This is to the end of the first quarter of this year. When you combine that with our diversification program, which is I would say is just only starting to pay off, we've beat AECO the last 13 of 18 years with this approach. We think it's important to have a hedging and diversification program because we expect volatility. We expect more volatility. If you think about what we've done, we've built supply up, we've built demand up, but we haven't built up, the buffer in between. The storage has remained relatively the same, and pipelines have been relatively the same. So if you think about, if we increase supply, let's say we have a warm winter or a cool summer, or Freeport goes down again, you can expect this volatility to happen, right? So that's why we believe in smoothing out those prices, and so we can run a steady program. Just a reminder, we have 70% hedged for the rest of the summer at $3.50 an MCF, and even better prices in Q4 or $4.09. And next summer we have lots hedged too at $3.88 an MCF. And if I'd like, of course, we'd all like nothing better than that to be out of the money, but if you think about the strip here going forward, it's pricing in LNG already. So it's a good thing we're ahead of the game already. It's already pricing in the LNG coming on next year. Besides our selling our gas to external markets, we've got this Cascade Power project where we're supplying directly to them. Of course, everybody always asking me about what's the status. We're ready to go. We've pressured up our pipeline. Our gas is waiting at the gate. They are now generating power at Cascade 1 and 2. People can go online and look at that. You can see that they're starting to burn power there, so that's exciting. It means we're getting close. But you have to be patient, wait for it. It'll come soon. Right now, the current estimates are somewhere in July of this year. So, of course, we can't share with you the details of the pricing of our 15-year, 52 million supply agreement. But if you look at power price forecasts in 24 and beyond, we should get well over the AECO future strip price as it is today. So we're excited, impatiently waiting for it to come on. And just a reminder, we're also part of the Rockies LNG Consortium as another diversification piece that we have, that's a real project. It's got the who's who of gas producers are part of this now, and even some oil producers as well in here. It's moving along through the environmental process. There's a pipeline right away, the PRGT, that's going to be able to be used to supply gas to this facility. It's a real project. It's moving ahead, and we're excited to be part of that. Thank you for coming. Hope to see you all next year. See you later.